Welcome to SI Partners' regular M&A update. This week we're at Cannes Lions, which always provides a useful barometer of deal activity in the marketing sector. And the headline is that deal volumes remain strong, perhaps surprisingly so given global risk factors like US-China relations, rising levels of corporate debt, not to mention the B word. But if you scratch the surface, there's more to this story. The number of pure marketing services agencies being acquired, those that effectively sell ideas and time, is falling. But this is being more than offset by an increase in acquisitions of tech-enabled businesses. There's a fairly obvious explanation for this, which is that clients are looking for ever more efficient and effective means of targeting, delivering and measuring content that's tailored to individual customers. SaaS businesses tend to disappoint for all but the most basic agency tasks, but managed services, which combine human talent with technology, increasing speed, accuracy and efficiency, are now really starting to hit their stride. And there's another reason for this shift towards tech-enabled agency acquisitions, which has more to do with the profile of the current buyers in the market. We've seen a big increase in the amount of marketing M&A that's driven by private equity money. And while PE houses currently have vast amounts of dry powder to deploy, they tend to get nervous around businesses that are entirely reliant on talent. So managed services and tech-enabled businesses with recurring revenue streams and scalable business models tend to make far more interesting targets for them. The key issue for PE funds, which we've mentioned before, is that there's a shortage of businesses of sufficient scale to meet their normal investment criteria. Ideally, a UK PE fund wants to write a cheque for at least £20 million on day one without buying more than, say, 60% of the shares. So they're looking for businesses that can support a valuation in excess of £30 million, which means either profits of 3 or 4 million or proven and highly scalable technology revenues. Competition for the few suitable assets out there is driving up prices to a level that many PE houses can't stomach. So to get around this problem, many funds are deploying their cash with existing investee companies and encouraging them to make secondary acquisitions as part of a buy and build strategy. And we've seen a lot more of this sort of activity in 2019. That's providing opportunities for smaller agencies to sell, although it's worth noting that often they'll be expected to take a decent chunk of consideration in shares to align them with the buyer and to keep them in the business until the future sale of the group and the PE fund's own exit. Sellers should also be aware that selling to a PE-backed agency comes with a higher level of scrutiny. You might not see much of the PE guys during the courtship phase or even up to the point of agreeing heads of terms, but once you get into due diligence, they're going to subject the business to a level of analysis that often goes far beyond what you'd expect from most buyers. And without solid preparation, that can easily derail a sale process. So it's no coincidence that our team here in Cannes is as likely to be meeting with financial investors as they are with strategic buyers. Private equity interest in this increasingly tech-powered sector, combined with their need to put the money they've raised to good use, means they're leaving no stone unturned in the search for interesting investment opportunities. Add in the steady advance of tech and management consultancies and a number of evolving and emerging marcoms groups, and perhaps it's not surprising that deal volumes remain so high despite the macroeconomic risks.